Joining us is BD8 Capital founder Barbara Doran and Citi U.S. equity strategist Scott Croner. Guys, welcome. Scott, we've got just over a week left in this month, really, I guess in the first half of the year. And you've got a 4,000 target for the S&P for end of year, which would be down about 9%. What are the adjustments that investors should be thinking about making here? Do you rebalance and shift gains to fixed income or international or smaller caps? Do you raise cash or do you just sit on your hands?
Well, it's a good question, John. So our normalized earnings yield analysis tells us that bonds actually look more attractive than stocks at this point. But I think that's been the case for some time now. In terms of the equity outlook, I mean, this is pretty straightforward. You've had this massive move in this narrow leadership, the NASDAQ names, let's call it. And our view is that you don't have that kind of move without some form of pullback on the premise that the higher you move these stocks, the greater the implicit expectations you build in, and it begins to feed on itself. Now, we got Russell Recon tomorrow and the quarter coming up, as you mentioned. We think the stage is set for a pullback, but what we would suggest is being holders. We're more excited about putting new money to work on the cyclical side of the market.
Barbara, how big of a pullback will it take to get you back into things?
Yeah, it's a good question, because I agree with Scott. After such a massive move, NASDAQ up almost 30% year to date, S&P 14%, it is normal to have a pullback. But I thought that a few weeks ago, and we haven't seen it. This market wants to go higher. You've got retail investors trying to come in. Institutional are underinvested. So I think any pullback we have will not be deep, and I think it'll be shallow and it'll be short. So that is, it's a tough question. It's like, the famous Supreme Court justice who said, "Hey, I'll know it when I see it," when referring to the test for pornography. You will see how the rest of the market is acting, but I don't think it will be deep. I think there's too much. I think the market is already discounting 1 to 2 more hikes, meaning the Fed is nearly done hiking, and I think that's what we're seeing in the market. And so I think, and I don't agree with Scott, however, on the cyclicals, because cyclicals typically do well if you're going to see the economy growing. And I see the economy, while still being positive growth, slowing a bit. And I think that's going to be true through the rest of the year.
So in light of that, Barbara, name some names for me, especially when we have had, we'll call it not surprising, but more hawkish talk from Fed Chair Powell over the last couple of days. We saw some surprise moves from other central banks just in the past 24 hours, and we've seen yields on treasuries moving higher. So what do you like right now? And is there a point at which interest rates moving back towards highs could change that?
Yeah, I think that if as the year goes on, if the Fed decides, if we see inflation actually start to go back up, which would be very surprising, then I think all bets are off. The Fed could go higher. But I think my expectation, and I think consensus, is that we will continue to see inflation creep down, with the core PCE stuck a little bit here. And that's why the Fed, I think, will keep rates higher. So I think, for now, I'm sitting on my hands. I'm buying selectively, like names like Starbucks, which really got hurt after they reported earnings. Fantastic earnings, 11% same-store sales, et cetera, but their forward guidance was not what people expected. But I think they're being very conservative. If you look at China, 6,000 stores there, they could be more stores there by 25 in the U.S., and the Chinese consumer is recovering in this aspect. So I think that's a very good story, has not done much in earnings. And you look at something like Expedia, which has had great growth in the online travel segment, not as quality a name as Booking Holdings, which has about twice the growth rate, but the stock is at only 11 PE. So I think there's upside there. So it's looking for names like that, very idiosyncratic picks.
Yeah. Scott, a lot of focus right now on the 2-10 spread and the yield curve inversion, also the 3-month to 10-year, and the fact that inversion continues. You had leading indicators, which we're going to get to in a little bit more detail in just a moment here with Mike Santoli. But if we were to actually see a recession here, when we talk about the possibility of a pullback, I mean, I guess just walk me through valuations for this market and how painful that could be. But also on the flip side, if we don't see a recession, whether valuations here actually would make sense and it would change your mind.
So, Morgan, it's a good question. So, beginning of this year, we were arguing the S&P could handle 18, 19 times our earnings estimate, which was 213 at the time. And we got a lot of pushback that was too aggressive for a outlook that included a recession scenario. And now we're above that. We're 20, 21, almost 21 times on the S&P. And so now we're being asked the question, oh, well, gee, how far much further can you push your valuations higher? What I would say is our view has been pretty steadfast on this. We think that this earnings resilience theme is going to be part of the landscape, even if we have a mild recession. The framework here is that if you look at the S&P 500, we characterize about 30% of it as, quote, cyclical. So the point here is that the S&P exposure to recession is not as great as is often perceived, okay? Now, in the meantime, recession timing continues to get pushed back, kick the can, if you will. And so what we're arguing is that from a valuation perspective, normalized valuations on the industrials and related actually look pretty attractive to us. We're willing to be a little bit early on this in the event that we do get an ongoing push out in terms of recession timing. And we want to be in the game if and when you do get to a point where we're talking more aggressively about a Fed pivot.
All right. Good discussion to kick off the hour here. I love when you get some differing viewpoints on the market, and especially given the fact that we're at such a key moment here for the market. Barbara Doran and Scott Kroner, thank you both.
Thank you.
Let's bring in senior markets commentator Mike Santoli at the New York Stock Exchange. Kind of just teased it, Mike, but what are you looking at?
Yeah, Morgan, we'll get to the LEI later, but did want to take a look at where yields are sitting, in particular the one-year Treasury bill. And, you know, we had global central banks hiking more than anticipated overnight. You had Powell out there, again, talking about the potential for 2 more hikes and trying to downplay the idea of a cut. Well, the one-year yield is essentially getting you there. We're at 5.3. This essentially says in a year's time, the Fed funds rate is likely to be in the zone where it is right now, maybe a bit higher, and we're pretty much at the highs for this cycle on this measure. So far the stock market containing that, but it does create perhaps a little more competition for bank deposits, and there's a little sloppiness in the way that the bank stocks have traded. Take a look at the spread between JP Morgan shares and the broad S&P 500 banks ETF. You see that departure here starting late last year, but really accelerating with the SVB collapse. This is not that encouraging. You know, we've kind of curled down, still up off the lows, still have a chance to be chopping around, making a base. But that premium, that safety premium in JP Morgan has again gone toward the extremes of early part of this year. So we're clinching up a little bit. Maybe it could just be about regulation, the fact that profitability is going to be challenged. The regional bank stocks are already probably pretty cheap. But I did want to highlight how some of this is creeping back into the market, even as the overall indexes hold near their highs.
Yeah, Mike, let's spend some more time on exactly that. The regional banks getting hit hard again today. That was a hot topic at today's Senate Banking Committee hearing. Fed Chair Jay Powell was asked whether he was concerned about uncertainty in the real estate market leading to more bank failures.
It's really which banks have concentrations, high concentrations of real estate, and that is not seen in the large banks. It's seen in some of the smaller banks. So we've identified those banks, and there's a supervisory toolkit where we work with banks to try to help them resolve those issues by raising capital or dealing with what's happening.
And meanwhile, Starwood Capital Group Chairman and CEO Barry Sternlicht said he's much more worried about the regional banks than Powell might be.
Things are not fine in the regional banks. He can say it all he wants, but the government is basically giving you an implied guarantee on deposits. So there's been no run on the rest of the banks. The banks are not in good shape, the regional banks. They all have commercial real estate loans. We can mark the securities to market.
Yeah, the KRE is certainly not in good shape today. I don't know if we can pull that up at all, but it was down more than 3%. Maybe that's not so out of line with what Powell was saying. Mike, what do you think?
No, not terribly out of line. I do think maybe we would characterize the concerns as more kind of this ongoing chronic drag on profitability and on the balance sheets of the banks, as opposed to some big sudden recognition that there's been a hole blown in the books, as happened at SVB, because really the market value of longer term bonds has not changed very much in the last few months. That was the thing that really did get recognized all of a sudden when it came to SVB. The regional banks ETF as in total is trading below stated book value, so it's not as if the market expects great things from it. It's much more about just really the wear and tear of asset values coming down and having to mark loans down. So I see it less as a possibility of being some kind of big liquidation panic and much more about, like, what are the business models here and just how much pain is left to be taken over time as commercial real estate kind of exposure works its way through the banks. Plus, they do still continue to talk about tighter reins on regulation and not letting them do as much in the future.
Yeah, I mean, Powell talked about it today, too. Capital increase is an upcoming proposal for larger banks. And just talking about this trade-off between making banks safer and the cost of credit. I mean, how important, though, to the broader rally? And, yeah, we saw the major averages finish flat or higher today and break some of the selling that we saw to start the week. But just looking at the strong gains for the month, how critical are the bank stocks and financials overall to the sustainability of this rally from here?
To me, it's always been that they can't be going down in a hurry and have the rest of the market shake it off. They don't have to lead. They don't have to recapture a huge percentage of the value lost over the course of the last few months, really, for the rest of the market to be okay. For the financial stress indicators are what's really going to matter for the broader market. What's happening with credit spreads, what's happening to some degree with bank availability and deposit flows. So far, that's calmed down. At this point, you know, money market yields haven't really changed that much. So that competition is not great for banks, but it's still not getting worse at a rapid rate. So at this point, you wouldn't want to see the regional banks take out their price lows of earlier this year, but we're a little ways from there.
Got it. All right, Mike Santoli, a.k.a. the Maestro. Thanks. We'll see you later this hour. Bitcoin rallying 80% so far this year. But our next guest will discuss whether BlackRock's bid for a Bitcoin ETF could spoil the party for investors. Morgan Creek Capital CEO Mark Yusko joins us when Overtime returns. Welcome back to Overtime. Bitcoin has seen a massive rally this year, up 82% so far. It's up 14% just this week and hovering back above 30K. BlackRock's application for a Bitcoin ETF has added fuel to the rally, but is the largest asset manager in the world a, quote, wolf in the henhouse? Joining us now is Mark Yusko from Morgan Creek Capital. Mark, it's great to have you on, and I'm going to start right there. When you have BlackRock entering the fray, and also, by the way, Citadel and Schwab and Fidelity backing EDX Markets, the crypto exchange that also launched this week, what does it signal?
Look, I think it's great that the traditional financial services firms are coming around to the technological innovation that's been going on for the last really 14 years since the birth of Bitcoin, but really the last 5 years have been the acceleration. And we knew that eventually the big firms would find their way into the space. But I actually think it's a validation of one, the technology, and two, validation of business models saying that, look, this is here to stay.
So this is good news, and this rally has legs. Is that what you're saying?
Well, I think the rally is just beginning. You know, we just entered what's called the seasonal period of crypto summer. There's this 4-year cycle around something called the halving, which is where the block rewards for the Bitcoin blockchain change every 4 years. That causes a period of accumulation going into that. That event will occur next April. That's called crypto summer. Then we usually get a speculative blow off after the halving event, and then a overreaction on the downside called crypto winter. So, you know, last week, June 15th was kind of the bridge into the 10 months coming into the halving. It just happened to coincide with BlackRock announcing their ETF. And we're up, I think, 15% since that announcement. But I think the rally is just beginning over the next year.
I'm just not convinced that this matters in a bold-faced way. I mean, it seems to me that crypto and Web3 kind of lost the narrative. This was supposed to be the future of finance and the future of, you know, technology. A lot of people, the future of commerce, a lot of people were saying. Now that narrative has moved to AI, and crypto is sort of more in the metaverse bin. Why is that wrong? And does this move and others like it that we're talking about today, does that move crypto and Bitcoin specifically any closer to being in charge of the narrative again?
Well, I think the narrative's actually completely wrong. The idea that the digital assets are in the waste bin, you know, seems kind of silly to me. We're talking about a $1.2 trillion asset from zero 14 years ago, $500 billion in Bitcoin alone.
Well, but we're not talking
kind of
about
silly to say we're not talking
about NFTs or virtual real estate in the same way anymore. People aren't trying to buy the virtual place next to Snoop Dogg's house. Like, people are concerned about actual commercial real estate right now.
Well, no, that's been the whole point all along, right? Blockchain technology is one of the 4 pillars of the digital age, the ABCDs, as we call them. That's AI, blockchain technology, computer chips, and data. Those 4 things are transforming the way we store and exchange value. The same way that media was completely disrupted by the internet and the value of the biggest media assets went to new assets, the same thing's happening in financial services. It's a long process. It doesn't happen overnight. It happens over decades. But every stock, every bond, every currency, every commodity, every piece of art, every private business, every piece of real estate will eventually be a token on a blockchain, an entry on a ledger, permanent and immutable. We will have truth